Okay, very good. So good evening again, everybody. So I'm using a little of a new setup today. So in case you can't hear me clearly, do let me know. How's everyone doing today? I guess maybe it's Monday. Okay, I guess it's because it's Monday as well. Our Monday blues. Yeah, but I guess the good way to kickstart your Monday is having a lecture, so you get it off your schedule for the week, and then after that things gets better as you approach Friday. Right. So today's lecture will not be too heavy, I would say, but we still have quite a bit of content to cover. Less calculations compared to lecture two. So for lecture two, I just want to highlight again, there is a lecture recording called lecture 2B. I hope everyone has managed to view it. So lecture 2B covers basically more problems or more questions relating to what we're covering in lecture 2A, which is the main lecture, which is on time value of money, right? So lecture 2B is a recording that I've done previously, and it's a mandatory kind of watch list or lecture that you should watch, because it covers all the problems, kind of elaborate more on how time value of money can be tested, whether is it for your class test or even for your finals or your GPA. Okay. Any questions regarding lecture 2B? Have have anyone started watching it yet or not really? Right. Maybe everyone's just still a bit tired, but okay, let's start. Okay, so let's start with lecture two. Sorry, lecture three. Right. So lecture three, let's kind of define a bit more on what is the idea of risk and rewards. Right. And the idea of it, right, like I mentioned in most of my lecture, I'd like to give you the broad overview first before we go into all the nitty-gritty details, etc. Right? So as a broad overview, right, the idea is that in finance, wherever you take on more risk, let me just pull out my pen. Whenever you take on risk, you should be rewarded by taking risk. Right? So that is the basis of today's lecture. And then we'll go into a lot of detail about it, right? But the idea of it, right? The simple idea is that if you take risk, you should be rewarded. Okay? However, this idea of risk in finance is very strict. So there's only certain kind of risk that you take, then you'll be rewarded. Anyone also experiencing a bit of choppy audio? Oh, same. Oh no, okay. A little. Oh, let's see. Because doing a new setup. Okay, maybe I just off my camera, see whether it's better. Let me just give it a try. Okay. Okay, let's try again. Okay. So do give me some feedback if in case it's still choppy. Because sometimes the video can take a lot of the bandwidth. All right. So like I mentioned earlier, in finance, right, when you take on risk, you have more rewards, right? And in finance, it's very particular that the type of risk you take is important. So not all risks will give you more rewards, right? So the idea is that greater the potential reward if there's greater risk. If you do let me know if it's still choppy, and then I'll see what I can do. If not, I'll just continue. Okay. Now let's look at the type of returns we're looking at. Okay, so we kind of define what is the whole purpose of today's lecture, right? Risk and rewards. So the higher the risk, higher the rewards. Now let's look at the idea of rewards, or in other words, returns, right? So the higher the return, or not very high, sorry, there are different types of return that we can define, right? So the total dollar return, um, imagine a stock, right? So a stock generally have two kind of return, right? Either it's a capital gain, right? Meaning that if you buy a stock now, maybe 2 years later, the stock price increased by $20, that's a capital gain. Second one is dividends gain, right? So every year, generally a company would distribute dividends, and these dividends come in the form of additional return for you, right? So your total return for idea of like a stock includes must include both the dividends and the capital gain, right? So both components. Okay, still a bit choppy. Uh, see what is it hard to understand to listen to what I'm saying? Uh, and anyone else experience happiness? Oh, there's a bit of echo. Mm, a bit of echo. Okay, because it's a new startup, that's why. Okay, okay. You know what? Let's give me a moment because I know that yeah, it might be very hard. So let me see where I can get a headphones. Give me a moment. Hello, is it better? Yeah, it's better. Is it too echoey or it's better? Yes, echoey or no? Okay, okay, right. All right, let's give it a try. If we still have issues, then we'll see what we can do. Um, okay, so we are talking earlier about returns, right? So in terms of returns, in a simple stock case, we have two returns. First, the dividends, and then the capital gains, right? The two. And these two returns give you the total returns. Okay. Okay. So in terms of capital gain is what you initially paid for and what you paid for and what you receive, right? So the difference of the two is your capital gains. Right. So we do have a formula here to formalize the idea is that if it's a dividend yield, we basically just look at what is the dividend that you receive divided by the price of the stock that you purchase. That is your dividend yield. Okay. And for capital gains is how much you purchase initially. Initially is PT, and then what happens after that, right? So PT plus one. So just imagine in a simple way. Let's say if you have a dividends, a capital initially you bought the stock for $100, later it became $120, um, and then thereafter you earn the $20, right? And then divide by the initial price of $100. So this is your capital gains. Um, Total return, whenever we talk about return, always be capital gain and dividend gain. Right, so capital gain and dividend gain. All right. So this is a numerical example to kind of illustrate it a bit more. Um, Imagine you have a dividend of $2. Your initial share price is 25. After 1 year, your share price is 35. You know that your capital gain is $10. Okay, when you put numbers, it's a bit easier. Your total return is 12. In terms of percentage, which is what we're more interested in. Whenever you look at finance, we always focus on percentages. So for the dividends, is 2 divided by 25, which is 8%. And then your capital is 10 divided by 25, the initial share price, 40. And then of course the combination you can just add these two together, or you just take 12 divided by 25. So your total returns is 48. So what's your total returns? Your total returns is 48. So the next few slides, there are quite a few graphs. They are not really important, it's just more to illustrate a point to you. And I'll just point out a few illustrations here, right? So this graph, like I say, is just purely for illustration. So this graph is such that you have various kind of stocks. You have your um, small companies, you have the large companies, inflation, and treasury bill, and long-term government bonds. Right? On your x-axis, you have number of years as given here. In terms of this index is basically the price, right? So I have a question for any of you, right? So in terms of, remember we mentioned earlier that risk and rewards are proportional, right? More risk you take, the more rewards you get, right? So based on this graph itself, which type of stocks or bonds do you think is the highest risk? Small companies? Thank you. That's right. They're right. Small companies, right? And the reason why is that in the small company stock, let's just zoom in a bit. can you see that the small companies not give you more rewards, the highest rewards among the one, two, four types of things, four types of securities? Yes, that's right. Higher gain, higher risk, right? Um, but at the same time, do you notice, even though there's a gains, but the loss is also a lot more, right? Can you see that in this portion here, let's just see, focus on this portion, see that the large company, which I guess is less return, dropped by like this only, right? But you can see a small company stock drops so much more, right? In terms of the V, it's so much more. So it really makes a difference, right? So higher the risk, higher the reward, but the rewards can cut you like a double-edged sword, right? So if the economy is not doing well, for a small company, you lose more money. So this is what I'm trying to illustrate here. One more thing I want to illustrate here is this. In terms of inflation and treasury bill, you can see that there's a close correlation between inflation and the treasury bill. So this means that generally the treasury bills are considered inflation equals to inflation. So how much is the inflation? It will give you how much the treasury bill is going to give you in terms of returns. So for example, like now the inflation is 5%, means that if you go and buy a treasury bill, which is like a risk-free asset, there's no risk, the treasury bill should give you 5%. Okay. Uh, on this point, nothing much. I'm not going to go through this. Because we already illustrated the point earlier. And so we have looked here, right? So now these are some numbers that we can kind of see. We see that the small company stocks, as you rightly pointed out, has the highest rewards, of course, more risk. In terms of, can you see that inflation and treasury bill very close? So generally, treasury bill is equals to inflation percentage, right? And in terms of, okay, so I have a question here. In terms of stocks, okay, we have one category for stocks, bonds, and treasury bills, right? So which one has the least risk? Okay, treasury bill, as one say government bonds. So there's so there are treasury. So hope you can see that the least risk, right? Remember I said risk and rewards are proportionate. So if it's lesser rewards means that you're taking lesser risk. So the least risk um, security is actually your treasury bill, right? Can you see it's lesser returns means that it's actually less risk. Okay, I hope you can see that. So the least risk item is your treasury bill here. Okay, not your government bonds. Treasury bills are actually government bonds as well, but the difference is that government bonds, it can be different type of bonds, right? But treasury bill is a bond that is issued by the treasury department in the government, right? So it's a very specific kind of bonds that which is why it's called a bill and it's issued by the treasury department. So this is the least risk. So this is the least risk. Okay. Oh, okay. So that's a good question. So inflation is actually not considered a security. This is not considered security. It's just that why is it placed here is because they want to illustrate that for treasury bill and inflation, basically treasury bills return is proportional to inflation. Yeah. So inflation is not really asset, so that's why yeah, it's not like an investment. Yeah, yeah, but that's a good point. So if we are given like a return on the asset, right? Or return on the stock. Basically, what you can do is you can simply, let's say you have 10 different kind of returns, right? So for 10 years, every year you have one return. So that's 5%, 8%, 10%, right? You have 10 different kind of returns. The simplest way to find what's the average return historically is just take the 10 count returns divided by the number which is 10, right? So total returns divided by, right? It's like your what you learn in secondary school, right? Simplest count way to do it. So let's say in this example, we have 86 years. Every year you have one return. You add up all the returns for the year and then divide by 86. So this is what I'm talking about, right? So all these are all the returns for the year. You just add up everything. So this is what you probably learn in secondary school. You just add everything, divide by 86. I want to highlight to you that this method of calculating returns is least preferred in finance, right? So yes, you have learned this in your mathematics, but this is the least preferred method, and then we'll come exactly why in just a bit, right? But just put that as back of your mind to remind yourself that this is the least preferred method. So I think I mentioned a little bit of this idea called risk-free, and so the idea is that treasury bills are considered risk-free, right? So it is issued by the treasury department in a country. And the idea is that the government of the country would not default on its payment, which is why it's considered there's no risk, right? If you buy a treasury bill from the government, there's no risk in your investment, right? So it's risk-free, and how they determine the returns for the treasury bill. I want to anyone can like to answer the question. How do you determine the returns for the treasury bill? So the hint is, remember, treasury bill is the return is very close to inflation. So I hope you can see that how the government determines the treasury bill return is based on the inflation rate. Yes, based on inflation. You're right. Okay, so I hope you can see that the treasury bill return is based on inflation. Okay. So if we know that treasury bill is risk-free, there's no risk, right? Anything above the risk-free amount, anything that's above risk-free is considered a risk premium, right? Excess of taking on additional risk, right? So rewards for bearing risk. So imagine there is a base, the lowest level is risk-free, right? Um, anything above that amount of risk that you're taking, you get a risk premium, and the idea of premium means that something additional, like additional to it. Okay. So if we know that treasury bills are risk-free, we know that the risk premium is zero, right? There is no risk because there's no risk. Now, having determined that the treasury bill return is 3.6, we can now determine all the risk premium, right? So we know that for the small stocks, this is the highest returns. We take 16.5 minus 3.6. So this is the amount of risk premium or additional risk they are taking, and hence additional rewards. There is a small comment here by definition, right? So generally, um, treasury bill is zero, but after the '08 financial crisis, um, they realized that actually the US government can actually default as well. So there's actually a risk involved, but it's by definition theoretically zero, but in real life it might not be zero. Right? So we have we have talked about returns, right? So as a finance student, right, we need to really focus on risk because we anyone can say, oh, this asset has 10% return, or you invest in Facebook stocks at 10% return, it's good. But the idea is that if you hopefully after taking this course, you kind of more take in consideration not only the returns but the risk, because if you have, remember, higher returns means higher risk, right? You're taking more risk. So the idea is that risk, how we measure risk is basically the dispersion or the spread of the return or volatility of returns. So understand it's like a normal distribution here, right? So imagine terms that are at the end here and at the end here, right? Meaning the two extreme ends of your normal distribution. It means that there is more, right? There's more dispersion. And because of this, then your risk is higher, right? So there's more spread here and here. Okay, so this is an important concept. I want to put a star here. So risk is based on dispersion, right? So in this slide, they mentioned that typically is a bell-shaped curve, it's symmetrical, um, and the normal distribution actually kind of describe the asset. Remember that distribution is defined by deviation, right? So in terms of the description of a security, you have the mean and standard deviation. Okay, I think I might know the issue why. Um, sorry about it again. Okay, give me a moment. Sorry about the disruption to today's lecture. Right. Okay. I hope this is better now. I changed my location. Uh, yeah. Sorry about this. Yeah. Okay. Let me know if you still can't hear me. Then see what I can do. Apologies on the distraction. Yeah. Just give me one moment. Okay. So, yes, let's go back to the previous slide. Okay. Again, sorry about it. All right. Okay. So we were just introducing the idea of risk. So the idea is that risk is based on the idea of the dispersion of the assets, of the returns, right? So risk in this sense is how dispersed the returns are. So the dispersion of the returns. And typically, as we talk more and more these returns, they form a normal distribution here, right? And so the thing is, when you have more returns at the extreme end, so you have returns that are like extreme, this will result in more dispersion or more volatility of your returns, right? Meaning that you have higher risk, right? So risk is proportionate to the idea of dispersion. And so in this slide, they just want to highlight to you that a normal distribution is a good way to describe a asset return. The reason being is that it's because it includes the mean and the standard deviation, right? So these will probably tap into your bit of your secondary school knowledge, right? We call that normal distribution. You can define a normal distribution using a mean and standard deviation. So because we can define your normal distribution using a mean and standard deviation, that is the reason why it's a good way to describe a return on the asset. Now, so we have talked about the risk, right? And recall that I say that, asset can be described with normal distribution. And so recall again your secondary school when you are kind of introduced the concept of normal distribution, is that we have this thing called variance, right? And the variance measures the dispersion, which is what we are interested in, the risk, right? So variance measures dispersion. Now, then recall that in previously you kind of know that, this thing called standard deviation, you basically just take the square root of the variance, right? Square root of variance gives you this thing called standard deviation. Um, and and so in our entire course, we define standard deviation as a total risk. So this measures total risk of asset. So whenever we want to describe the risk of asset or the total risk, more precise, total risk of asset is the standard deviation, right? So I have a question for everyone. No, the question is, why do we define the total risk of asset using standard deviation and not variance? Anyone like to give this a try? So the question again is, why do we define the total risk of asset using standard deviation instead of variance?
Hi, Prof. Can I try?
Yeah, sure.
Yeah,
Go for it.
so I think variance is basically uh okay, so my understanding of variance is based on like certain games I play. So
Okay.
basically it's like a average, right? Say I play 10 games against a superior opponent. The chances of me winning is not zero, but it's probably like two. But this is
Okay.
like based on like variance and overall. But standard deviation takes into account like all the figures that have been populated before, and then takes all the
Mhm.
games, and then they compile into like maybe I won't say average, but it's like probably like I think it's more accurate. That's my understanding of like variance versus standard deviation.
I think the last point is kind of getting there. It's like, yes, it's a bit more accurate. Yeah, yeah, right. So it is more accurate. No, anyone like you can try it. So it just needs a bit more. But why is it more accurate? So thanks for the answer. Yeah, almost there. Yeah. So this is a bit tough. So don't worry, no, you'll not be tested on this, like why is it right? But it's good for general understanding, right? Okay, so it's a bit of a tough question. And the idea is that if you see this, right, variance is this sigma squared, right? And the thing about variance is that imagine if you take like let's say you want to measure a pencil, right? Measure the length of pencil, different pencil. So the different pencil you measure has different lengths, right? So you have variability, right? And the thing is that because variance is sigma square, the formula of variance will give you this thing called Cm squared. After you calculate we are not going to calculate variance, but if you do it mathematically, you put in the formula in your secondary school, at the end of the day, right, the unit for the variability of your tensor is Cm squared. And the problem with this is that Cm squared is like, it doesn't mean anything. Like, what does 1 cm square means of a pencil. Like the variability is 1 cm square, right? So there's this accuracy issue that we're facing. However, if we're going to square root this to give you the standard deviation, the square cancels off. And so we can say that, oh, the pencil now has a standard deviation of 1 cm. Now, it makes more sense, right? Standard deviation of 1 cm means that, oh, we know that pencil A versus pencil B, there is some differences of 1 cm, right? So the whole idea is that variance is the measure of dispersion, which cannot be one, but variance is in the wrong unit, so it's not accurate than what it is. But once we square root it, give standard deviation, is the right unit. So this comment here is very important. Same units as average. So this is what we want. Yes, that's right. You're totally right. Yeah. So same unit as the measurement, which is why we use standard deviation. And so in the same sense, returns are always in percentages, right? So percentage returns. And so for standard deviation is in percentage, but for variance, your returns will be percentage squared, which has no meaning, percentage squared. Very difficult to understand. Payment here is important one to consider. Yeah. This is the formula for variance. So hopefully you can still recall your secondary school. The idea is that we have a real example later, but the idea is that we have returns. We must always minus away the mean of the returns. Then you divided it, and then you sum all the individual stuff up, right? And then you divided it by t minus 1, right? T meaning like if you have 10 returns, you take 10 minus 1, 9. So divide by 9, right? And so we do have an example here, okay? So do not worry. Now, I do have a question. Oh, yeah.
Is variance the same as probability?
Okay, so that's a good question. So the thing is, it's not. So probability is, let's flip a coin, right? What's the probability of a hit is 50%.
Yeah.
Okay, but variance is really about the dispersion. So if you draw normal distribution, the variance is how dispersed your whatever thing is, right? So for example, right, let's say if we have a normal distribution like this, okay, versus something like this, like very big, right? So you can see that this one, the first one has lesser variance, right? It's only very narrow. Now this one can tell that, oh, there's so much variability here. So
So
there's
it's
a
like
lot of variance.
data spread, like how spread is the data.
Yes, you're right. So
So
data, yeah, how spread, yes.
I I can't really remember what standard deviation is. Could you help me recap that? Sorry.
Okay, so standard deviation, right? the only reason why it exists is because of the units history. So standard deviation is simply the square root of variance. And the idea is, why do we even have this thing called standard deviation? It's because of the issue of units in variance. Because the units in variance is square, but has no meaning. Like what I mentioned about the pencil, like cm square has no meaning. That's why we need to square root it so that it becomes a cm. So that's the only meaning of standard deviation.
Also, it's like just to make the number make sense.
Yeah, yeah,
Yeah,
you're right.
thank you.
Right. Most welcome. Um, so we will see how to calculate variance in just the next slide. Now, I do have a question for any one of you who still can remember what your mathematics teacher told you in secondary school. The question is, why do we need to take t minus 1? Why not just divide by t?
Is it because of year zero or something like that?
Okay, not really. Probably your math teacher told you about it. Uh, Again, it will not be tested, but it's good for understanding. Anyone like to give a try? One more try before I explain. Okay, so the last to answer about that. So if you come by average, you're right, and remove bias. So you're kind of right. Okay, so around that. So the idea is that this thing called minus one is this thing called degree of freedom. So hopefully this degree of freedom. Okay, so maybe this rings a small bell, but the idea is that this thing called degree of freedom. And imagine this, right? Imagine you have uh let's say three set of numbers. So three numbers, right? 5, 8, 10, right? And then we have let's say 5 plus 8, 18, 18 plus 23. So this gives you 23. So if let's say we have 23 divided by 3, right? We have the average there. So 23 divided by 3, calculator, let's just see. Okay, it is 7.6. Let's just say 7.6, right? Good. 7.6. So the idea is that if we have, so if we in the data, right, the data set, we have these three numbers here. We have the average, which is 7.6, right? Do we actually need three numbers, these three numbers? No, right? Because imagine we do not have this number here. We cancel this. Imagine you have two numbers and we have an average of 7.6. Can we actually derive the third number? We can, right? You can see this. We can actually derive the this missing number if we have the average and two numbers, right? And so in the variance formula, this variance formula here, variance formula, we are using the average. We have the number of returns here, right? Ri. So do we actually really need the last number? Don't. And which is why we minus one. We do not need this number. We just need two numbers, actually, right? So this is the reason why it's minus one. Again, this is for purely for your understanding. You need not know this for any assessment and exam, right? It's just to understand, oh, why minus one? Sometimes you might even see minus two, minus three, right? So really just it's just for understanding. Okay, so let's have a look example of a variance. So imagine we have 1, 2, 3, 4, 5. We have 5 different years. Each year you have a return of 11.14, 3.7, no, sorry, 37.13, 43.31, etc. Right? We have all the returns given. Now, we find the average of it. So how do you find the average? We just add all this number up, right? Add it and then you just divided it by 5, right? You find the average. Now, remember that the variance formula is you take the returns, Ri, minus average, right? So you take 11.14 minus 11.48, take 37.13 minus 11.48, you take 43.31 minus 10.48. So these are the differences. After that, you square it based on the variance formula, you square everything, and then you sum it up here. You sum it up. Now, this gives you the variance, but remember, you can't stop the variance because of the units issue, because it's a percentage square, because returns are all in percentages. So your so you need to calculate standard deviation, which is just a square root of your variance. Okay. There is a very important comment here. I'll just put a star here. It's because in this question, they only give you terms, right? But sometimes if you go to Yahoo, let's say you go to Yahoo Finance, you pull out the data for, let's say, Facebook stocks. The data is generally not in returns. Sometimes it's given stock prices. So you calculate returns. Remember what we talked about earlier? How do you calculate returns if you are given stock price?
It's the price you bought minus the final price. Returns is essentially profit.
Correct. Yeah, totally right. So you must take the initial price, final price minus initial price divided by initial price, right? So you need to calculate the returns, right, for all your years. Okay. So just be very careful. Some questions can be very tricky. They give you stock price, but you cannot use stock price. You need to calculate what's the returns. Okay. This is just careful. Now we understand that risk is based on the variability, right? How varied the dispersion of or the spread of the data is. Now, can we see from this distribution here, based on the variability of the spread, which one has the most spread or variability?
Prof, sorry, can you go back to the slide? Just now the returns you said we need to divide by 2, but the formula I thought it was like unless you want to find the average return, but if you are just trying to find like your year-on-year returns, you can just take like the closing price versus like you can just take the price you bought it at minus the final price, right? If you need like year-on-year returns.
Yeah. So okay. So year-on-year return means that let's say now is 2020, let's say 2020, then you apply 2021 return, you take 2020 price minus 2021 price,
Yeah.
divide by 2020 price. Yeah, all right.
Oh,
So
need to
each
divide by
year's
2020 price.
yes, right. Because return is a percentage, right? So
Okay,
remember,
yeah, okay,
yeah,
right.
you need to divide by
Yeah,
the
thank you.
original price to get the percentage.
Yeah, okay, thanks.
Welcome. Okay, so going back to this slide, the question is, based on the distribution that you can see here, which stock has the highest risk? So the question is, based on the distribution, which stock has the highest risk? Anyone like to give it a try?
The small company stocks, right? The
Yeah,
data is really
yes, that's right. More company because of the dispersion, right? The spread is so much, right? Spread of data. Okay, compared to these, the spread is lesser. Compared to bonds, even lesser. Uh, Government bonds, even lesser, right? So remember, uh, risk is based on the spread. Spread is measured by standard deviation because for variance we cannot. It's the units issue, so that's why we don't use variance, we use standard deviation. Right? Hope this is very clear. Okay, so now we have tackled variance. Now let's talk about the mean. So just now we calculated this thing called arithmetic mean, which is like the simplest one, right? If you have 5 data, we add all the 5 data, divide by 5, right? That's arithmetic mean. So there's some comment here, but in layman term, it's just add up all the data, divide by 5, right? That's arithmetic mean.
Now, there's this thing called geometric mean, which is the mean that actually we're interested in finance, right? So in finance, we never really use arithmetic mean, we always use geometric mean. And the idea is that we are taking into account the average compounded returns, right? So arithmetic mean is just the returns, just add it all up, divide by the number of period, right? But geometric mean takes into account compounding, which is what we have really focused on in the last lecture, where we will say that in finance, we always consider compounding as an important concept. Right? So in finance, we always use geometric mean. And they think about geometric mean, the characteristic is that it's always less than arithmetic mean, unless there is unless all the returns are the same. Right? And then maybe the question is, okay, so how do we calculate geometric mean? So there is this formula here. It looks a bit scary, don't worry. We have an example to just illustrate. Basically, the idea is that we just take 1 plus the returns times 1 plus the second return, you multiply all it up, and then you the power of 1 over the number of returns, then you minus 1. Right? So this might look a bit complicated. Do not worry. Let's look at an example. This is another way to represent it. This simply means the product, right? Let's multiply everything. It's simpler when you look at it as a number. Okay, so let's have a look at this example here. We have a stock, right? In year 1, the stock is $1. Sorry. Year 1, the stock is $1. Year 2, stock is $2. Year 3, the stock becomes $1. Recall that I mentioned how to calculate returns if I do stock price. So how do you calculate 100% here? We just take $2 minus $1 divided by $1, right? So it's 100%. The second one is how you get negative 50%. We take in $1 minus $2 divided by $2, right? So it's negative 50%, right? So this makes it clear how we calculate returns. If you're going to calculate arithmetic return, we simply take the two returns, add them together, and divide by 2, right? Get 25%. Okay, this is a simple one. Now, if you geometric return, we must take 1 plus the returns times 1 plus the other return. Then we to the power of 1 over 2, because it's 1 over t, so 1 over 2, minus 1. And then geometric return is 0. I have a question for all of you. Which return, geometric or arithmetic, makes more sense for you?
So, Prof, can you repeat your question?
Okay, so the question is, between the arithmetic and geometric return, which one makes more sense? When you look at the numbers, I see somebody say geometric, okay, 2% say geometric. Geometric, okay. So those that say geometric, you are right. Okay, let's just think about it in just non-finance stuff, right? Non-finance, just look at the stock price. Can you see that if I buy the stock at $1 year 1, in year 3 I sold it for $1. Do I make any money? No, correct? You can see it's no, right? Now, geometric return says make 0 money, which is correct. But can you see the arithmetic say, hey, you're making 25%? That's not true, right? You make 0. You know that if you just look at numbers itself, don't even talk about finance. If you have $1 year 1, $1 year 3, you're making money, right? So in this very simple example, we can see that geometric is the right way to understand. Geometric return is the right way to understand your returns, which is this is the one that we always use in finance. And we never use this. Okay. Hope in this example, it becomes very clear that geometric is the right way to do it.
Prof, the formula for geometric is basically you take your percentage your return percentage every year, then you like
multiply.
Oh, okay, yeah, you multiply, then you like to the power of half lah, then you minus 1. Like,
Yeah, but not always half, because this one there is two returns, so it's half. If it's three returns, you take one divided by three. So
okay. So the number below is depending on how many returns there are. Lah.
yes, that's right.
Okay, thank you.
That's right. Welcome. So now we have an example here with more returns to come illustrate geometric returns to you. So we have the returns given here. Now you just one plus the returns, right? Because these are in percentage, the commas are percentage. So 11.14% is 0.111, right? So we have one plus the returns. And then after that, you compound. What does compound mean? You take this return, this one times this one, right? To get you this. And then I say take this one times this one, this is this, right? So you just compound it. At the end of it, you need to do the power of 1 over 5. Why 5? Because you have 5 number of years, 5 years. So if you have 3, it's 1 to the power 1 over 3. Since it's 5, it's 1 to the power 1 over 5. And then after that, don't forget to minus 1, right? Minus 1 at the end, get 8.6%. I'm just going to flip back to the formula. So hopefully now this makes sense to you. So you have to 1 plus the return and multiply by 1 plus the second return, multiply by 1 plus the third return. After that, everything to the power of 1 divided by number of return, which is 5, 1 divided by 5, and minus 1. Why is that minus 1? It's part of the formula, that's why there's a minus 1. But the idea is that because you have added 1 here, so mathematically you need to minus, right? But in the formula, you have always to minus 1 again. Yeah. Because you have added 1, so you need to minus it again. So I hope now this formula makes sense, make more sense to you. What does 1 plus r and all this thing, right? Once you have some numbers, hopefully this makes sense. So because geometric return uses the concept of compounding, a good way to calculate your geometric return if you are given what is the value at the end of the year, the compounded return at the end, is actually time value of money, like what we covered last lecture. So the idea is that, okay, if I'm given this final value, I do not know all this, so these are all not given to me. I don't know all this, right? I tell you that the compounded return at year 5 is 1.800. Now, with this number, you can actually just use your IY function. We call that this is the rate function in cell. So we know that if there's 5 years, n is 5. Your present value is 1, because remember, it starts with 1 and you keep on compounding it. So starts with 1, but of course it's negative because that's where your money is coming out of the pocket. We call that what we talk about. And then we assume no payment because there's no cash coming in, cash coming out. And you know the final value is 1.4870. With these figures, we can actually use the time value of money rate function, Excel, to determine your geometric return. So this method is very important. The reason why is that some questions do not give you all the data like this. They give you partial data, right? They say, oh, the compounded return in year 5 is this. Calculate what is the geometric return. So you need to know that you can actually use time value of money because geometric return is compounding. So the question is which is better? Generally, because we know that geometric return will be always less than arithmetic return. Arithmetic can be overly optimistic. geometric overly pessimistic. There's this part here saying depends, right? So the question is like, oh, if it's 15 to 20 years, use arithmetic. If it's beyond 40 years, use geometric. So this is a very rough gauge, but to be honest, in real life, if you are going off to work in finance, banking, everyone uses geometry regardless of the number of years, right? So this is just kind of a guideline, but generally no one uses arithmetic because we see that there's a real issue, right? You have $1 year one, $1 year three, and your arithmetic is giving you wrong answers. So the thing is, we always use arithmetic. Sorry, we always use geometric. We never use arithmetic in real life. Right? So, but this is just a guideline for you. Okay, let's just before we go on to the next part of today's lecture, let's take a short break. We come back at around 8:15. Yeah. And then we cover the next part on efficient market hypothesis. Right. Again, I want to apologize for the earlier disruption, but hopefully now it's better. If you do have some issues listening, just drop me a chat, message. Right. So we come back at around 8:15. All right. Welcome back. Welcome back. We can start, right? Um. Okay. So let's continue the next part of the lecture. So at the start of the lecture, we mentioned about concept, right? That risk and rewards are proportional, right? And recall that I mentioned that in finance, the type of risk is very specific, right? Um, you only get rewards by taking on certain kind of risk, right? Not all kind of risk. So let's try to understand this using this concept called efficient market hypothesis, right? So in the efficient market hypothesis, this is basically an idea, right? An idea that someone came up. And the idea is that on average, stock prices are at equilibrium. Equilibrium meaning that they're all fairly priced, right? They're fairly priced, and information that's efficiency, meaning what? When new information is being released, they are being priced into the market, right? Immediately the market's like, oh, okay, we found out on this new information, the stock price increased, the price decreased, etc. Right? So it's efficient. The information is efficiently priced into the market. Now, of course, if this is true, it means that the investor cannot earn abnormal returns. Okay, so this part is important. What's that here? So the idea of abnormal returns or alpha returns, so they're the same thing, right? It's just different names. The idea of abnormal returns is that returns that are extraordinary, right? There's not like normal, extraordinary kind of returns. And this does not mean that the investor cannot earn any returns. So the investor can earn returns, but it must be a normal kind of returns. It's not abnormal returns, right? So it's impossible that the investor can beat the market, right? So this is the important part, is that efficient market hypothesis says that the investor can earn returns, but it is only a normal return, not an abnormal or excess returns. So investor can earn market returns. Now this is very important. So again, I repeat one last time is that efficient market hypothesis says that investor can earn returns, normal returns, but not normal returns or not alpha returns. Okay, so let's kind of understand a little more about this market, right? So in an efficient market, what does this mean? It means that whenever the new information is being released, the stock price, if it's efficient, will jump up immediately, right? It goes up immediately. And then the stock price remains at that number, right? Market is very efficient, straight away the stock price jump and then it remains the number. Now, this is not very common in the market. In real life, what happens is generally the stock price either goes up slightly, like it goes up slowly, it is, or sometimes the stock price goes up and then it drops down because it's react too much, right? Overreact. It goes up too much and then they go back down to the correct number, right? So because of this, generally in real life, the stock market is inefficient. So it's not efficient. So either it goes up slowly like this, or it goes up and goes down because there's some overreaction happening. Okay, so in this efficient market hypothesis or this theory of it, there's three kinds of market. The first market is a strong form, then strong form and weak form. So we'll go into details, right? So this is a summary slide, but let's go to the next slide. We'll go into detail what does it mean. So a strong form, right, means that it reflects all information. So upward start here, all kind of information, whether it's a public information or private information. So any kind of information, right, the market will price this information in, even if it's private. So just between you and me, we have some special information about the stock of this company. This will be priced in the market, right? And because of that, everything is being priced in the market. All information is being priced. we cannot earn abnormal returns at all. Because any information you have, even the insider information, any kind of information, all will be priced in. And so because of this, there's no point to specifically buy one stock or try to beat the market. So what do? We just hold a diversified portfolio. We just hold like S&P 500, right? Because there's no way that we're going to beat the market. We just hold a diversified portfolio and just leave it there. However, in real life, what the market is actually not sure for, because we know that if you have some kind of insider information, like let's say between you and me, we can actually earn some abnormal return. We can beat the market, we can earn some return that's special, right? That only person with the information can have, right? So we know that if you have insider information, you can earn special abnormal returns. And so we know that because of this, the market is not a strong form. Okay. Now, what is semi-strong form? So a semi-strong form means that it's weaker, right? So semi-strong. It means that the price only reflects publicly available information. So what does this mean? It means that things like trading information, annual reports, press releases, all public. Now, if you have private information, the price of the stock will not include that, right? So if this is true, it means that investors cannot earn abnormal returns based on public information. It also means that investor can earn abnormal returns if you have some private information between you and the company or whatever, right? That is private. So this implies that fundamental analysis will not lead to abnormal returns. So what is fundamental analysis? Fundamental analysis is what we talked about in lecture 1. Remember, we did a ratio analysis. We talk about the company calculate what is the debt to equity ratio, what is the leverage ratio. So those calculations are fundamental analysis. They write some explanation about what does the ratio mean. So those are all fundamental analysis. So it means that if it's a strong, semi-strong form, because the market includes all the information already, all public information, if you do this kind of ratio analysis, they will not give you any abnormal returns because it's already all priced in, right? And so this, if it's semi-strong, this is considered efficient market, right? But if you do fundamental analysis, use ratio analysis, there will be no abnormal returns that you can gain from it. Okay, the last count, efficiency. Remember, all these are theories. So the last form is weak form. So weak form means that the market only includes market information. So what's market information? Market information is considered like, I don't know, things like volume, volume information, price information of the stock, right? What's the price? So this kind of like how much volume being traded, what's the price, is market information. And so in a weak form, market only includes this kind of information. And this means that an investor cannot earn abnormal returns if you are trading on market information. So it also means that this they call technical analysis. So what's technical analysis? Technical analysis is like, let's say you look at some graph, you look at the movement of the stocks like this, and then sometimes you draw like certain lines and graph trying to say, generally is this upwards trend or is it a downwards trend? You draw some lines. So these are technical analysis. So it means that technical analysis using this kind of like graphing of the stock price, etc., will not give you abnormal returns. However, if you use fundamental analysis, which is the ratios that we talked about in lecture 1, this fundamental analysis can actually give you some abnormal returns. Right? And so empirically, based on studies, based on research, it's found that the market is generally considered in a weak form, which means that if you do fundamental analysis, if you do things like ratio analysis, these will give you positive returns or positive abnormal returns. I'll just pause for a short while. Any questions regarding these three forms of the market? All good? Any questions? Yeah.
Basically, over here it says that if you're just using like if you're just using like open information, market information, you will never make abnormal returns lah. Basically, like based on the current market.
Yes, so there are three different theories, right? Three different types of market. So for this weak form, if you are just using market information, you will not make any profit based on market information.
Okay, can. But the current market that we are experiencing now is weak market.
Weak form. Yeah. Yeah. So I see a question, okay, example of what causes abnormal return. Okay, so in real life, we are in a weak form, right? Weak form. So weak form only includes market information. Means what? It means that if you have private information, private meaning that insider trading, you can't know the CEO of let's say Apple, like Apple Corporation, or like Singtel. You know the CEO of Singtel, the CEO will tell you that, oh, you know what, we are going to have a new 6G, let's say 6G, they are going to invest in 6G, right? And because of this information, you quickly go to buy the Singtel stocks. The Singtel stocks will increase because they later they announced that, oh, they are doing 6G and the market is very positive, and then the stock price increase, right? So if you have this private information that you know that they are going to invest 6G, this will allow you to have abnormal returns, right? Because for a normal investor, we will not know about this and we will not be able to get this return. But because you have this special information that's private between you and the CEO, that's why you can get abnormal returns. Does this make sense? Yeah, okay, that's good. Okay. So this is just a pictorial version of efficient market hypothesis, nothing to talk about. Okay, so this is just to emphasize again what I talked about earlier, that this concept of efficient market hypothesis, which is like a theory, does not mean that you cannot make money, right? You can make money, but you only can make money that is appropriate for amount of risk that you undertake, right? So you take more risk, you get more returns, right? And there is no bias in terms of price that can be exploited to earn excess returns. So it means that you cannot get returns that's excess, right? Abnormal alpha returns. You cannot get that, right? Now, there's this very important part way to start here is that the efficient market hypothesis assumes that you diversify your portfolio. What does it mean? It means that you do not put all your eggs in one basket. So, some of you maybe already started the investment, right? You know that, let's say if you're buying individual stocks, right? You know that, oh, you shouldn't put, let's say you have $10,000. You shouldn't put $10,000 in just one stock. Let's say you buy $10,000 in Facebook. You shouldn't do that, right? You should do like maybe 5,000 in Facebook, 2,000 in Singtel, 3,000 in let's say Semcom, right? So you put in different stocks, right? This is called diversification. So the efficient market hypothesis says that this is only true if your investment is fully diversified. So if you do not diversify, the efficient market hypothesis does not protect you from making the wrong choice. Right? So you cannot say, oh, based on efficient market hypothesis, you cannot use, let's say, for big form, market information is useless. Right? Okay, this is only true if you have fully diversified your portfolio. Okay. So that's all for efficient market hypothesis. Any last question before we move on to the next part of the lecture? right? So these are some examples when you practice. I really encourage you to give this a try because it really helps you understand how to do the calculations, right? So let's move on to the second part of the lecture here. So this is going back to again the returns concept. So earlier, remember we talked about total returns, which is dividend yield plus the capital gains yield. So now those are just returns, right? But now we have this thing called probability coming in. I think fellow student of yours mentioned about, oh, so what's the difference between probability and variance, right? So now we are bringing the idea of probability to our calculation. And when we bring probability, it will be this thing called expected. So what do you expect? Because when you expect something, that is based on probability, right? So what's the expectation of a 10% return? Maybe say the probability is 30% chance of a 10% return, right? So there's an expectation happening. So whenever we talk about expectation, there's a probability involved. And so we need to know what is the probability of that state, is a state happening, right? Of 10% return. What is the probability of 10% return? Maybe the probability is 30% chance of it happening, right? So we have an example here to illustrate how we calculate this thing of expected return by taking into account probability. So imagine you have three different states in the economy: recession, neutral state, and a boom state. And for each state, there's a probability involved, right? So recession is 0.25, neutral is 0.5, and boom is 0.25, right? And so we have the various stock returns here. And so what do? We just multiply them, right? The probability of them happening. So the next slide kind of show you how you just multiply them. The probability times the returns. This gives you, and then after that you sum it up together, gives you the expected return. Then you take the probability times the expected return, and then sum it up, gives you the expected return. So maybe you notice that there's this 1 and 2 here. So what does this mean? It means that the first step to do is you take probability times return. That's why I put a 1 here. The next step is you sum it up, right? So this step 2. So you sum all the figures up, and this is your expected return. Now, we have the expected variance and expected standard deviation as well. And when we have expected, we need to consider the probability. So again, it's the same thing. We recall that for the variance formula, we take the returns minus the average, right? Average is expected, so minus the average. Then it doesn't end there because you need to multiply by probability, and then you sum it up. We have an example to illustrate to you how we calculate the variance and standard deviation for expected returns. Okay. So we have the returns given here. We have the various states 0.25, 0.5, and 0.25 for the pool. So we calculate what's the expected return as given here. Okay. Once we determine what expected return, recall that we need to take the, I'm just going to flip back to the previous slide. We take the RI minus the expected return, right? So what does this mean? It means you take 20% or negative 20% minus the expected returns, then you square root it here, right? We give you what's the deviation. The next step, then you multiply by probability. In this sense, this is 0.25. So it's you take 0.25 multiplied by this one to give you this 0.5 multiplied by this thing to give you this, right? So you multiply by probability. Last but not least, you sum it up to give you the variance here. And you square root it to give you standard deviation. Okay, so I'm just going to flip back to the previous slide to show you what does this mean. 1, 2, 3. So 1 is you take returns minus expected. Step 2, you multiply probability. Step 3, you sum it up. Okay, so you work by, you can follow the 1, 2, 3 to calculate the variance. Any questions? Pause for a short while. I strongly encourage you to give this a try, to do it in Excel. Try it once. Usually, once you do it once, you kind of know the format to do it. It'll be easy, right? So just give it a try to see whether you get the numbers. Okay. All right. So now we move on to the idea of portfolio. So earlier I mentioned about the efficient market hypothesis, and we talked a little about this thing called portfolio, right? Portfolio meaning that you have more than one stock in your basket. So if, for example, you have a stock of Facebook, Intel, Apple. Let's say you have multiple stock. And so when you have multiple stock in a basket, it's called portfolio now. So it's a collection of assets. So the thing is, whenever you have a collection of assets like this, like a multiple count of assets, it will kind of affect the risk and return of your portfolio. And generally, the portfolio is being we use expected returns and expected standard deviation to determine the value. Okay. So the question, then my following up question is, how does adding more stocks affect your risk and return? Anyone kind of roughly know or have kind of read ahead or studied before? So the question is, how does adding more stocks in your portfolio affect your returns and your risk? Anyone roughly know or actually not very sure? Then we will continue to go through. So maybe not too sure, depends, reduce the risk, depends on what. Okay, I think maybe you kind of either you read ahead or you kind of know it from general knowledge. Yeah, right. So there is some kind of risk reduction, and that's correct. So now, thanks for answering. So let's see what kind of risk is being reduced when you have a portfolio here. Okay, so whenever you think of a portfolio, we are in the expected return category, right? So expected, so the probability involved. Now we have one more component. We have this weight W. So W gives you what's the percentage of the portfolio is asset A, right? There's a weight involved now. Okay. Okay, and then we have example to show you. Okay, so imagine you have in your portfolio there are various investment dollars, right? You invested, let's say, 9,800 asset D, 5,800 asset E, right? So you can calculate what's the weight, percentage weight. Okay, and let's say they already give you expected return, right? So you do not need to calculate the probability times the return. They already calculate for you, so you just expected return, right? So they are quite nice to give expected return. So to calculate the portfolio return, you simply take what is the weight of asset A multiplied by return, gives you this, right? What's the weight of this multiplied by this gives you this, right? So you just take the weight multiplied by expected return, gives you the weight times the return, and if you add all of them up together, this will now give you your portfolio return. Okay, so in this example here, they are very nice. They really calculate for you expected return. Now, in the next example, they are not so nice to you. They give you the probability, they give you the returns, and so you need to calculate the expected returns. The same method, so 0.25 times negative 20%, 0.5 times 17.5% for stock V, and then 0.25 times 35% for stock V. So when you need to calculate expected returns, you calculate, then you need to multiply by the weight. Multiply them by the weight here like this to finally get you 10%. Okay, so be very clear and very careful. What did they give you? Are they giving you expected returns or are they giving you returns? So in the second case, it's returns, so you need to multiply by the probability given expected returns. Okay, so portfolio risk. So earlier your classmate mentioned, right, there's some risk reduction. So in the portfolio returns, you can see you just add up all the returns, right? What the weight times the returns, weight times returns, they add up all together, you get a portfolio return. Now, for the standard deviation, which relates to the risk of the portfolio or the total risk of the portfolio standard deviation is not the weighted average of the standard deviation, right? So you do not just take percentage of asset A multiplied by standard deviation of asset A plus the percentage of asset B times the standard deviation of asset B, A plus add up. You cannot do that. For portfolio, because there's some risk reduction, is not a weighted average. If it's so, there will be no benefits for diversification, right? So right. So let me just, so I generally do not like to do these two steps, these two slides, because I have a better slide that can illustrate what is portfolio standard deviation. Okay, so let's look at this example here, which gives you some how we calculate portfolio standard deviation. Now, let's say we are given two stocks, right? BB and SM. So two kind of stocks. They give you the return already, which is percentages. Now we have three portfolios, portfolio A, B, and C. And portfolio A has 25% of BB, 75% of SM. Portfolio B has 50% of BB, 50% of SM. So there are three different portfolios, right? So the question is, can you calculate portfolio mean and standard deviation? Okay, so there are two methods that I'll illustrate to you, and you need to know both methods. The first method I'll call it the statistical method. The second method is the finance method, right? So it's important to know both. Okay? Now let's come understand what is the statistical method. So the statistical method is method one. So what do you do? You calculate the return for each year, right? 2016, 2017, 2018, right? For each year, what is the return of the portfolio? So those in red is what I have showed you the workings, but basically you just keep on doing for all the other black numbers, you get the same, right? So I just want to show you the method of calculating. So for example, for the year 2016, the portfolio A, we know that it's 25% of let's see, 25% of BB and 75% of SM, right? So we know that for 2016, the returns for BB is negative 6.29. Okay, you can flip over to have a look. Here you have your slides. And the return for SM is 8.23. So you just multiply by the weight, you multiply by weight, and this gives you 4.6, which is the return of portfolio A in 2016. Right? So you repeat this for 2017, 2018. And then you repeat this again for portfolio B. And portfolio B is 50% SM and 50% BB, right? So you multiply it again, 50% times the return of 2017, 50% times the return on SM for 2017. Right? So you get this, which is the red figure here, and this, which is from portfolio C. Now, we have calculated all the returns for different years. And how do you calculate the mean? The mean is simply just add up all the numbers here divided by 5. This is the mean return for portfolio A. Any questions? Any doubts? Yeah, I guess we're good. All right. Now, having calculated your returns, we can just use this thing called the Excel formula standard deviation dot S. Okay, so I want to highlight to you that you must always use the dot S formula for your Excel, right? Because the dot S means you are using a sample and not a population. So whenever you're using a sample, that's where you will have the T minus 1, right? That's the degree of freedom that you talk about. Now, if you do not use this dot S formula, your answer will be slightly off because Excel will treat it as a population, and wherever you have a population, there is no T minus 1, just divide by T. Okay, so that's a slight difference. So what do? You just use the Excel formula, standard deviation dot S, and you plug in all this figure here, right? All the returns for your portfolio. Let's say A for the 5 years, it will give you 8.77. You do the same for portfolio B, you plug in this for the 5 years, will give you 8.84, and you plug in this, right? And so why do I call it the statistical method? So the reason why I call it the statistical method is that the returns, how they calculate the standard deviation of this portfolio is basically what you do, you plot the returns, right? 4.6, as we plot here, negative, you have like something like this, like this, like this, like this. And then after that, you almost like draw a normal distribution, right? So you draw like a normal distribution, and then you use this Excel formula to determine what is the standard deviation based on this normal distribution, right? That's why it's like you're using statistics, right? Because you know the mean, and then you have the different points, you plot it, and it becomes like a normal distribution, and this gives you a standard deviation of 8.77%. Okay. Any questions for this statistical method for standard deviation? Yeah. Yes, not. If you do have any questions when we review your lecture slides or the recording, do not hesitate to drop me an email, right? Okay, so that's all for method one, statistical method. Statistical method. Now, let's look at the finance method, which is actually more commonly used in finance, right? Again, I mentioned you to know both methods. Now, in the finance method, let's start off the mean again. Let's talk about. So the mean, right? What do? We look at the asset PB and asset. So how do we determine the mean? We just add the mean of PB is just add all these 5 return divide by 5, right? We get the mean of 6.16. We do the same for SM, add all and divide by 5. We get the mean return for SM, which is a stock of 3.88. Now, the question is for portfolio A, what do? We know portfolio is 25% of EB and 25% of SM. So we just multiply 25% times 6.16, which is what we found here. Then take 75% of SM, multiply by the mean of 3.33. And so this is what we get here, right? So this is the portfolio mean, portfolio A. right? So we do the same for portfolio B, portfolio C, and we get all the portfolio B. And if you go and compare, so if you have a slide, just flip back 2 slides. It's exactly the same as the method we used previously, right? But this is the finance method. Now, for the standard deviation, this is the interesting part. Okay, so instead of, because we do not have the individual years portfolio return, right? Like what we had in the statistical method. So I'm just going to flip over to show you. You don't have these, right? Individual years return portfolio. Then we can just track and say, use the Excel formula standard deviation of S. We can't do that because we do not have it, right? So what do we have to do? In the finance method, we simply take the standard deviation of BB, standard deviation of SF. Again, we use the same thing. Standard deviation dot S. Once this is done, we need to use this formula given here. And what is this formula trying to say? It says that the portfolio variance in a portfolio is equals to the weight of 1 square, so weight of the first asset square, times the variance plus the weight of asset 2 square times the variance plus 2 times the weight of asset 1, asset 2, and this thing called covariance. So COV1, 2. So COV1, 2 is the joint variability, right? The joint variability of two assets. So what does this mean? In simple terms, right, is how the two assets, asset 1 and 2, when combined together, how does the combined spread of data looks like, right? So this is called covariance. The covariance, CO, so CO, co is two, variance, right? Covariance. So the joint variability of the two assets. So this looks a bit complicated, but actually it's not so complicated once you see the numbers. Okay, so how do we compare this covariance? Very simple with Excel. You use the covariance.s formula and you put in this chunk of numbers here, right? These are all your return numbers for BB and SF. So this is the joint returns for 5 years. Okay, so once you determine the covariance of this number, so covariance is 0.000365. Once you determine this, you can calculate the portfolio variance, right? And so you basically just use the same formula, remember? So the formula is weight square, so 25% square times the returns 13.88, as we calculated earlier. 5% square, 10.62. So I'm just going to click over to show you where you get the 10.62. So it's here, right? We calculated the standard deviation of BB and SF, right? We have done that. Now, then we take 2 times the weight of 1 times weight of 2 times the covariance that we have calculated in the last slide. This gives you 0.77%. But we want standard deviation because of the units issue, so we square root this to give you 8.77. So if you compare this 8.77 method 2 with the finance method, the statistical method, can you see that it's exactly the same, 8.77. Okay, so there is a small comment here. There's this thing called, since Excel gives you covariance, let's say, right, question gives you correlation. So there's a formula where the correlation of asset equals to the covariance divided by standard deviation X, standard deviation Y. So it means what? So remember your secondary school, that is X-Men thing. X-Men, you can X it like this. So covariance of asset 1 and 2 equals to the correlation of 1 and 2, asset 1 and 2, multiplied by the standard deviation of 1, standard deviation of 2. So recall, you can just do the cross multiplication like this. So in whatever case, if the question gives you correlation, you can determine what's the covariance by this formula. Okay, so any questions on this? Because this is an important calculation. These two methods are very important. Any questions? Any part you need me to repeat? So I really encourage you to review these calculations after lecture and try to do it once. Right? Once you do it once, it makes a lot of sense. It's not difficult, you just need to be very careful when you do it. And with Excel, it's very fast. Okay, so that's all that we have for portfolio standard deviation and how we calculate it. So we have two methods that I mentioned earlier. Now, there's this small comment here, right? The idea is, recall that the efficient market hypothesis, where we mentioned that if the market is efficient, the stock price would like jump up and go straight, right? But most of the time I say, oh, but the market is not true. Generally, it will go up like this, or it go up and then it go down, right? There's some overreaction and then you go back down, right? So the idea is that you need to have surprise information for the stock to go up like this, right? To go up like that. Whether is it this way or this way, then this way, or this way, right? Need some like surprise, right? But whenever there's surprise, means that the market is not efficient, right? Then it doesn't put all the information. That's why there's surprises happening, right? So in order for the market to be efficient, there must be some inefficiency in the market, so that there's surprises. And whenever there's surprises, then we can say, oh, because the market is inefficient, there's some surprises, and then we can see whether how efficient the market is. Whether is it going up like this, or is it inefficient, it's going up like this, right? Or going up and down like that. So in this sense, market efficiency becomes like a self-fulfilling prophecy, where you need inefficiency to make the market more efficient, and then overall it becomes more efficient. Now, in terms of return, we have talked about total returns. Anyone can recall, remember total returns, we use the capital gain and dividends gain, right? Both of them combined to create total returns. Now, let's think about it slightly differently in terms of expected or unexpected returns. So the same kind of returns, but let's segregate it to whether it's expected, unexpected. So on average, generally things are, if it's unexpected, it will be zero because it kind of balances out. The unexpected positive balances out unexpected negative. So it will all be zero. And the unexpected component is what we don't say about surprise information. Things that you don't expect. It's a surprise, therefore it causes the stock to increase or decrease. The expected return is the one that is part of the market, the information is there, it's available. So that's your expected return. Okay, so your total return is a combination of expected and unexpected. Now, let's break the unexpected component a bit more, right? So the unexpected component here can be broken down into two parts, systematic and unsystematic. Okay, so what does this mean? Okay, we'll have a full definition of what it means, right? But just put this information in mind. So the unexpected can be broken down into systematic, unsystematic component. And so if we have the expected, systematic, unsystematic. These three components give you the total returns. Okay. Right. So now let's think what is systematic and systematic. So a systematic returns or systematic risk, because risk and return are, you know, proportional to each other. So systematic risk is any risk that cannot be diversified away. It means what? It's the risk that is in the market itself. Right? That's what the market is. It's inside the market. And this includes things like inflation is a systematic risk. It systematically affects all companies, right? It's the market. Change in GDP, it affects all companies, right? It's systematically affecting all companies. So systematic risks are the risks that cannot be diversified. It affects everyone, regardless whether you're SIA, you're Singtel, it affects you, right? Interest rate, it affects everybody. And this kind of risk, very important, you cannot diversify away. It's always there. Now, you have this thing of unsystematic risk. So unsystematic risk is the risk that can be diversified away. And what does it mean? It means that it's the risk that is unique to one company. So for example, if you buy some Singtel shares, you have a systematic risk that is unique to Singtel. For example, it can be things like your, let's say, a wireless outage. Let's say your Wi-Fi, the Singtel Wi-Fi wireless outage. So this risk of outage for your wireless is systematic, is unique to Singtel. Right? So it's unsystematic, it's unique to Singtel. And so this kind of risk can be diversified. What does the risk mean? It means that, let's say you have Singtel, right? You have Singtel, and then let's say you add something else, you add SIA, right? So let's say if you have a wireless outage for Singtel, affects the Singtel users, affects the Singtel stock, but it doesn't affect SIA, right? There's no effect on SIA. And so if you combine Singtel and SIA together in a portfolio, and this unsystematic risk of a outage will be removed because they cancel out each other, right? This will reduce the risk of the Singtel Wi-Fi outage. And so unsystematic risks are risks that can be diversified, removed. So going back to the idea of diversification. So the idea is that diversification, like what your friend mentioned earlier, reduces risk, right? It reduces the risk. However, it doesn't reduce all risk. It only reduces the unsystematic risk, right? Risk that can be diversified, unsystematic. And what remains is your systematic risk. Risk that things like GDP, interest rate, inflation, those risks cannot be diversified away and would stay in your company or stay in your portfolio. And when you have this diversification happening, the nice thing about diversification is that it reduces risk without reduction expected return. So you still going to get the same return, but your risk has been reduced. I want to highlight here is that diversification can only reduce your unsystematic risk, and your minimum level of risk is your systematic risk that's being left there. Maybe we just talk about two more concepts before we take our second break, like the usual style that we do, 2 breaks every hour. So let's just talk about this thing called correlation, right? So we can't talk about it where whenever I say if you put in more assets into your portfolio, it reduces your unsystematic risk, right? And so the question is, how much unsystematic risk being reduced? Right? Is it really reduced like 10%, 20%, or 50%? This is being determined by this thing called correlation. So correlation is the how correlated asset is. So let's put in the simple terms, right? Let's say you buy Sheng stocks and fair price stocks, right? Sheng and fair price, are they very correlated or uncorrelated? So the question is, if I buy Sheng and fair price, are they correlated or uncorrelated? Correlated. Yeah, right. They are correlated stocks. Yes, because they correlate each other, right? Because let's say during COVID, right, grocery stocks increased like crazy because people cannot buy eat, so they only can buy groceries, right? So they are very correlated. So this is almost like a perfect correlation, and so there is no risk reduction. Correlated. Now, if we buy SIA stocks and fair price stocks during COVID, they are very uncorrelated, right? Because during COVID, what happens? People go grocery shopping because they cannot go to restaurants to eat. They buy and spend on groceries. But at the same time, they can't travel, right? So they spend less on travel. So can you see that they are both very uncorrelated and it's almost like a negative correlation. And when this happens, let's say you own fair price stocks and SIA stocks. Maybe your SIA stocks dropped like crazy during COVID, but your fair price stocks increase a lot. And so this increase and decrease kind of offset each other, and therefore there is risk diversification happening. So there's diversification. Of course, this perfect negative correlation is very rare. Most of the time, it's just less than one. So there's like correlation, a slight negative correlation, right? We don't have 100% correlation, 100% negative correlation, so that there's perfect risk diversification. Of course, when we talk about correlation, we are only referring to the unsystematic risk because that's the only companies that can be diversified. Okay, so the question now is, so how much stock should I put in my portfolio, right? Should I put 1 million stocks? Should I put 10,000 stocks or should I put 20 stocks, right? How much of the unsystematic risk can be diversified? And based on research, based on market data, they notice that up to around 40 stocks, that is the kind of the maximum they can diversify with. The unsystematic risk after you have more than 40 stocks doesn't decrease too much. And so this is the example that you see here. This portion here, the blue, is the non-diversifiable risk or the systematic risk. You have your diversifiable risk or unsystematic risk would decrease as you add more and more number of stocks in the portfolio, right? Keep on decreasing until we hit around 40 stocks. And that's all. You cannot diversify away your unsystematic risk. They're all being diversified away already. So in terms of risk, the total risk is given by the systematic and unsystematic combined. Recall that total risk is measured by standard deviation. And for a fully diversified company, all the unsystematic risk is gone, and so you only left your systematic risk. So your total risk for your fully diversified portfolio is just your systematic risk. Okay. All right. Maybe we take a short break before we move on to the last part of the lecture. Let's try to come back around 9:50, if that's okay. So it's around 7 minutes. Right. If you do have any questions, drop them in the chat. We'll answer them after the short break. Welcome back. Welcome back. Last part of the lecture. How's everyone doing? Okay. All right. Yes, everyone's fine. Okay, let's continue last time, right? So just before the short break that we had, we were talking about the systematic and systematic risk. Um, and so the whole idea, right? Remember the start of this direction, right? We talk about risk and rewards. More risk you take, more rewards you get. Now, having understood this concept of systematic and unsystematic risk, which risk give you more rewards? Systematic or unsystematic? Anyone like to just you can type answer or unmute yourself. So which risk, the question is which risk give you rewards? Unsystematic or systematic risk give you more rewards? Okay, we have one answer unsystematic. Anyone like other answer? I want to give a try. Which kind of risk will give you more rewards? Okay, systematic. So we have two unsystematic. So unsystematic risk, is this risk diversifiable? Can you diversify unsystematic risk? Yes. Yes. Okay. So you know that you can diversify unsystematic risk. It means that actually, should you take on some unsystematic risk if you can diversify them away? Should you take on unsystematic risk? No. Okay. I hope you can see, everyone can see. Okay, depends on what you're investing in. I guess so. But if you have a portfolio, right, if you can diversify away all your unsystematic risk, you shouldn't even take on the risk. In other words, there is actually no rewards if you are bearing unnecessary risk. I.e., if you are taking on unsystematic risk by not diversifying your portfolio, you will not be rewarded. So you only get rewards by bearing systematic risk. Only systematic risk will you be rewarded. So unsystematic risk is assumed that you must diversify it away. So the expected return depends only on the systematic risk of the asset. Only. So this is very important. Unsystematic risk is fully diversifiable. It should be diversified away. Okay. So the question is, what is systematic risk? Right? We know that unsystematic risk should be diversified away. And so we should remove it from our portfolio by adding more and more stocks. We add maybe 40 stocks, and then our unsystematic risks are all diversified away. Right? Now, for your systematic risk, this systematic risk is measured by this thing called beta. Right? And you see beta quite a bit in the subsequent lectures as well. And it's not like a fictitious thing, right? So what is beta? So it's important to understand that beta is just a measure of systematic risk. Right? So each stock has its own beta. So stock A has a beta A, stock B has beta, right? And what does beta measure? It measures the relative volatility of the stock to the market. So let's say you have Apple stock. So the Apple beta basically measures how volatile Apple is relative to the whole market, right? The whole market. Maybe in the US S&P 500. So relative S&P 500, how volatile is Apple, right? This is measured by this concept called beta, which measures the systematic risk. Now, the average risk of a market is beta 1, right? So 1 is the average. So if you buy S&P 500, you buy a Straits Times Index, for Singapore stocks, the beta is 1, right? This is the average beta. Now, any beta that is more than 1 means that this stock is more risky or more systematic risk than the market or than the average. Similarly, if it's less than 1, it's less risky or less systematic risk. So the idea of beta is just a measure of systematic risk, and the market beta is beta of 1. This is a very important definition you need to know. Market beta is 1. Now, a T-bill. Anyone would like to recall what does a T-bill stands for? The return on a T-bill gives you the question is what does a T-bill represents? Treasury bill, okay, but in terms of the concept, what does it represent? Inflation, you're right, inflation, and they are considered risk-free, right? No risk. Because no risk. And so if it's no risk, means your systematic risk for the T-bill is 0. Meaning what? Meaning your beta is 0. So I hope you can draw the relationship now. So T-bill measures the return based on inflation, but in terms of risk perspective, T-bill has no risk. And since there's no risk, means no systematic risk. And in this sense, your beta is 0. There's no systematic risk. Okay. So these are your just example of beta. And the beautiful thing of beta is that you can just, let's say you have a portfolio, right? You just take the weight, multiply the beta, weight multiply beta, and you can get all the different, you can get a portfolio beta, right? It's simply the weighted average of the portfolio. That's the weighted average. I see a question. What? I think it's just a conversation. Yeah, if you do have a question, please let me know. Okay, so the portfolio beta is simply the weighted average of individual betas for stocks in the portfolio. Okay, so a quick concept check, right? Which security has more total risk? C or K? Okay. The question is, what is the measure of total risk? Total. Okay, so what is the measure of total risk? C cause it's more than 1. Okay. This is a trick question. So recall, total risk is measured by standard deviation. Yeah, that's right. You're right. So total risk is based on standard. You are right. So based on this, which one has higher standard deviation? K. That's right. Okay. So maybe it was emphasized enough. I'm just going to flip back to the start of today's lecture. Okay, so spare me a while. I'm just going to flip back, right, to this part here. Can you see? Standard deviation measures total risk. So this is very important. So total risk is measured by standard deviation. Okay, I hope you can put a point in your studies when you look at this slide. So total risk is measured by standard deviation, which is given by which has the highest value security K. Now, which asset has more systematic risk? So this is K here. So which one has more systematic risk? D, Y. higher beta, you are right. So this is C because of the higher beta. Now, the thing is, which asset should have higher expected return? Which asset? And why? So, anyone want to give it a try? Which asset should have the higher expected return? More risk, more return, you're right. But which one has more risk? And remember, in finance, risk is very specific. It's not all kind of risk that we say more risk, more rewards. But which kind of risk, which asset should have higher expected return? Because it's only if you bear certain kind of risk, right? Okay, I hope you can see that the asset that has higher risk is E, right? Recall that, remember, standard deviation. So let me explain this concept again. This is a very important concept. So standard deviation measures total risk, right? Risk, total risk includes systematic, unsystematic. Now, unsystematic is assumed that you're supposed to diversify all gone, right? And so you are only being rewarded if you take on systematic risk. And systematic risk is measured using data. And so for part 3 of this question, which one have a higher expected return? It must be based on the higher data because you're taking on more systematic risk, and therefore you should be rewarded by taking on more of this specific type of risk or systematic risk. Is this very clear? Anyone needs me to repeat because it's a very important concept. So the answer is C. Which one should have higher expected return? C. Okay. Just one last time, you are only rewarded by taking on risk that is systematic in nature. And so the higher expected return is your security that has the higher beta. So what's the point of SD? So SD gives you total risk, right? So the thing is, sometimes you might not be able to fully diversify away your unsystematic risk. That's why you do want to measure total risk in terms of standard deviation. Okay. Recall at the start of today's lecture, we talked about this thing called risk premium, right? And risk premium is just what is your return minus your risk free. And what security is risk free? What security is risk free? Anyone like to try? T-bill, yeah, right. So the T-bill is the risk-free. So recall at the start of the lecture, we saw the percentage, right? We saw, I think, 20% minus 3.6%. 3.6 is the T-bill, right? So you're right. So T-bill is risk-free. So we have risk premium is the return minus the T-bill. Higher the beta, higher the risk premium, which makes sense because higher beta, higher systematic risk means that you will get more premium, right? More returns. So we can actually define a relationship between risk, premium, and the beta. Okay, so this graph is very complicated, but let's try to make it easy for you, right? Let's dissect this, and it's very important to understand this graph. Okay, so question, what is the equation of a line? This is your secondary school. Anyone can recall? Equation of a straight line. Y equals mx plus c. You're right. Perfect. Okay. So we have a graph that's been plotted here. We have different kind of beta measuring systematic risk, and then we have the return of the beta, right? Recall I mentioned that there are two important beta numbers that we didn't know. What is the market beta? One. You're right. So market beta given here as one. Now, what is the beta of a risk-free T-bill? Zero, right? You're right. So this point is your risk-free, zero. And this is your market beta. So your beta of zero is your risk-free RF. Your beta of one gives you your market return, and your market return is like S&P 500 return or your Straits Time Index return, right? So they are market returns. Now, if you have 2 points on a line, you can actually find the gradient, right? Your M. You can find what's M, right? So what's M? M equals to ERM minus RF, right? Y2 minus Y1 divided by X2 minus X1, right? This is the basic formula of a gradient, right? So X2 minus X1. So what does this equals to? Equals to R minus RF. So this is the gradient of this line, which is given here, right? We have just determined the gradient of the line with the 2 points that we have. Okay, now with the gradient of the line, can I actually write the equation of the line now? I have C as well, right? C is the y-intercept. So I can actually write the equation of the line. So equation of the line equals to y, which is E I plus n is your gradient, ERN minus RF, right? X. So you want to multiply this whole thing by BI plus C. What's C? RF, right? So I'm just writing equation of line, which is actually given here, right? This thing is equation of line here. But I just want to show you that this formula is from the very simple y equals mx plus c, right? So having written the equation of the line, we know that with this equation of the line, we can actually determine any point along the line here, right? Can determine any point here if we know what is the either what is the return, the y, or we know what is the x, the beta. Okay, so this equation is a very important equation, right? And so the idea is that with this equation, we can determine either the return or the beta. And most of the time, we want to determine the return. So we can determine the return on the asset based on the beta given. And with this gradient M, this gradient M here gives you this thing called the risk and reward ratio. Okay, see, it's exactly the same as the gradient ERJ. The sense was ERM because we use the market. So I'm just going to show you again. We use the market point here and RF, right? But if we are using a random point RJ, it's just ERJ minus RF divided by beta J, right? Beta J. So in the previous example, because we use a specific point of one, so it's like easy. But let's say we want a random point here, right? So this is your beta J. So your beta J will give you, sorry, it's a bit messy here. Your beta J will give you E J, right? As seen here, ERJ. So this is a specific name called the risk and reward ratio or the trainer ratio, and it gives you the point or the slope of the line where the ratio gives you the how much risk you take, give you how much reward. So, question to all of you: do you prefer a steeper gradient or a more gentler gradient in terms of more, if you want more rewards? Steeper. Yeah, right. Can tell it's steeper, right? So the ratio is higher. More rewards per risk doing it. Yeah, I hope you can see that. Now, having understood it, that you know that in equilibrium, the ratio, the gradient, is the same for all assets. This makes sense, right? I hope you can see it. At equilibrium, all your asset would lie on the line here. It means that all of your asset has the same gradient. And when you plot the line, everything will be on the straight line. And so this equilibrium concept is very important. It means that whenever you are at equilibrium, you are in a situation where you are fully diversified away. Meaning what? Meaning that you will not be given returns if you're not fully diversified, if you have unsystematic risk that is not being diversified, you will not be given returns. Your security market line, or SLN in short, security market line, so this is the term for it, this equation is called security market line, is a situation of the equilibrium state where you are fully diversified. So this is again, this is a repeat, is a market equivalent state of a portfolio where it gives you the risk and rewards where you're fully diversified. Okay. Okay, equilibrium, all returns of security must fall exactly on the security market line. So, if you look at previous past year semesters, exam or even assessment, generally they really like to test you on this understanding. So you need to know that, okay, you can use the security market line to determine your expected return, but you need to know the preconditions or the caveats that's required in order to use this security market line equation. And so one of it is market equilibrium, the other one is you need to ensure that you are fully diversified away all your unsystematic risks and you are only being rewarded by taking on beta risk or systematic risk. Okay, so these are just repeat, I'll not go through again. Now, there's just some characteristics that we'd like to mention on the security market line, which is interesting. Already one of them you mentioned about the gradient, the more steeper, the more risk, more rewards you get per risk, right? So there are some things here. The gradient thing is right, change in slope here. So if there's a change in attitude towards risk and rewards, it will change the slope of the security market. So we already talked about this, right? Now, if you have a change in risk characteristics of individual investments, so risk characteristic means if there's a change in the beta, right? So you're just imagine a line, security market line like this, you're just moving along the line, right? Here you move along the line, different beta characteristics. So the movement along the security market line would give you different returns. Now, if there's a change in market conditions, what happens now? If there's change in market conditions like inflation, your whole line is going to shift. So there's a shift of the line going up or shift going down. So a shift down or shift up. Right? So it's a parallel shift. So if it's a change in market conditions, it's a parallel shift. Now, the equation of your y equals mx plus c of your security market line has a special name. This special name the equation of the line is called CAPM, right? Capital Asset Pricing Model. And it's given by this. So I'm just going to flip back to just to prove to you that we have already written this formula down, right? So there's no need to memorize it. So can you see that we have already written this formula here? This is the equation of the line of the security market line. Now, then your question is, okay, so you are given this formula, so what's the purpose of this? So the main purpose of this formula is to determine the expected return on the asset based on the data given. So based on this data, what's your return? And this is calculated using the security market line, Y versus X plus C. So a few important concepts to take note of for your market returns is given by S&P 500 for US stocks, or is given by Straits Times Index. Your risk premium is given by the expected return minus your risk-free assets. Okay, so in assessment, you need to read very carefully. Okay, read very carefully what are they giving you. Are they giving you market return, which is RM, or are they giving you market risk premium, which is expected RM minus RM, right? In other words, are they already giving you this chunk of thing, or are they giving you different color this one, right? So please read the question carefully, like very carefully. What number are they giving you? Are they giving you market return, which is this market return, or are they giving you market risk premium, which is this, right? So sometimes they say market risk premium is 2%. It means that this is 2%, right? ERN minus RF 2%. Sometimes they say market return is 2%, means that they are only giving you this one. Yeah. Okay, so please be very careful. So this formula basically says that if you know what's the beta, you can determine the expected returns. Again, to stress again, for CAPM, we are only compensated by assuming beta risk or systematic risk. If you assume other kind of risk, no one's going to reward you for that. Okay, so we have an example here. Let's look at this. We are given the beta and we are given the market return and risk-free. Market return and risk-free, right? And so the question is this an overvalued or undervalued stock? Okay, so let's use the CAPM model that we just learned, this one here, right? So how do we get the CAPM? We take this market return. So be very careful, this give you market return. So we take 12% minus 7.5%, give you the market risk premium, multiply by the beta. We are calculating stock A, right? Multiply by beta 1.3 plus the risk free of 1.75. So we calculate that based on CAPM. So I'm just going to write the formula here that we can calculate it. So it's 7.5 plus 12 minus 7.5 times the beta of 1.3, right? So this will give you 13.4. And so this is your return using your CAPM model, right? So you're supposed to get 13.4% in stock A. But you actually expect to get 14, right? So by Cat M, you calculate 13.4, but then in actual fact, you actually will get 14%, which means your stock is undervalued, right? Because it's good. Imagine you calculate it's only 13.4, but then in reality, you expect to get 14, which is perfect. And you always want an undervalued stock, which means that it's good. You get more returns. Now, if you do the same thing, you calculate your stock B, what you notice for stock B, based on Cat M, you are only supposed to get 11.1%. In reality, you get 10%, which is less. So this is an overvalue. The stock is too overvalued already. Right? It's not good. You want to always sell away your overvalued stock, buy undervalued stock. Any questions? I'll pause here for short. So I hope you can see why is this CAP-M model important. CAP-M model helps you calculate the return you're supposed to get, and from there you can determine whether your stock is undervalued or overvalued. We always want to buy something that's undervalued, which means good, and not that overvalued. So, okay, yeah, I'll wait. You have a question? Okay, sure. Let me explain the undervalued overvalued. Okay, so based on your CAP-M, you have calculated this return here for stock A, 13.4. So this is theoretically what you're supposed to get, right? Theoretically, you're supposed to get 13.4%. Now, however, in reality, that you are getting 14%. And this is good, right? Theoretically, you get 13, but in reality, you get 14. Means that you're getting around 0.6% more. And so in this sense, it's considered an undervalued stock, because your theoretical calculated value is less than your real value that you get, which is 40%. Yes, is that clear? Okay. Now I'm going to use stock B to explain again. So in stock B, we calculated the theoretical value based on CAP-M as 11.1% here. Now, in reality, you're getting 10%, which is less than your theoretical value. Means that your theoretical value is more than your real value that you get in the market, 10%. Hence, it's considered a overvalued stock. Okay, yeah, this is very important. So yeah, thanks for asking to clarify. This is very important. Okay, so this is your CAP-M model. Uh, Last time to highlight to you, market risk premium is different from market risk. So please take note what the question is giving you, market risk premium or market risk. For example, in the last question is giving you market return, so market risk. So you need to take 12% minus 7.5 to get a market risk premium. Right? So actually, that's all I have for you today. So these are self-review questions. Any questions you have for what we have covered? Any questions or maybe any feedback? Would you prefer, the slower, or you think the pace is just nice? Do you have any questions regarding the upcoming class quiz? Yeah, feel free. You can feel free to unmute yourself or start the group chat. Okay, a bit fast. Okay, so maybe we'll try to go a bit slower next class. I would encourage you to so try to review if you have time, maybe on the train or the bus, try to review the slides before the lecture, right? So it will help you to also uh, pick up the information a bit faster. But okay, we'll go a bit slower next time. Yeah, today got yes. So yeah, sorry about that. Can I just check, is it better now? Or does it feel a bit echoey? You know, let me just pause the recording as well.